5, the consolidated work paper in 20x4, the year of acquisition. We now close in E1, we close common stock by debiting it, and retained earnings of S company given are the amounts of 240,000 and 120,000, and we credit investment in S company and non-controlling interest for 72,000. So the credit to investment in S company is 360,000 times 80%. That gives credit of 288,000. Next, in E2, we now have the adjustments as computed in requirement 1. Debit to inventory, 6,000 for the undervaluation. We debit to accumulated depreciation of equipment in the amount of 96,000, so that the initial amount of accumulated depreciation of equipment of totaling 135,000 and 96,000. Now we are debiting back accumulated depreciation of equipment by another 96,000. And accumulated depreciation of the building account by 192,000. We debit to land for the undervaluation, debit to discount on bonds payable, 4,800, and we credit to buildings as computed above of 216,000, credit to non-controlling interest. 90,000 is the amount of the undervaluation. We multiply it by 20%. So we now credit non-controlling interest by 18,000, and credit investment in S company for 84,000. Now we have the credit to investment in the amount of 84,000. Initially, you have a credit in E1 of 288,000. Now we have the investment in S company for 84,000. Actually, the original debit to investment account is the amount of investment of P company given in the first part of the problem, 372,000, and then we deduct 288,000 credited in E1. There's a difference of 84,000 that we have to credit in E2. So the entries now will be to debit inventory, debit accumulated depreciation of the equipment, debit accumulated depreciation of the building, then we debit to land, we debit to discount on bonds payable, and finally credit to buildings and non-controlling interest and investment in S company. We are now debiting goodwill for the amount of 12,000 for the remainder to goodwill. Now, next entry in E3, debit to cost of goods sold, debit depreciation expense for 6,000, debit to accumulated depreciation of the buildings, 6,000, Then debit to interest expense for the amortization of the discount on bonds payable. Debit to goodwill impairment loss, that's equal to 3,000. If the impairment loss is 3,750 and 80% of that is equal to 3,000. That goes to the parent. Goodwill impairment loss. Credit to inventory again, and then credit to accumulated depreciation of equipment in the amount of 12,000, and credit to discount on bonds payable 1,200, and credit goodwill. So the explanation: to provide for 20x for impairment loss and depreciation and amortization on differences between acquisition date fair value and book value of Sun's identifiable assets and liabilities. So we are now given the breakdown of these figures. Okay, so the net amount of 13,200 as found in the table. Okay, so we have now E3, E4 for here. It should be observed that the goodwill computed above was proportional to the controlling interest of 80% and the non-controlling interest of 20% computed as follows. Now, the goodwill applicable to parent is 80%, the goodwill applicable to the non-controlling interest. So the total goodwill is 15,000 for 100% interest. Therefore, the goodwill impairment loss of 3,750, please make correction. The goodwill impairment loss of 3,750 based on 100% fair value or full goodwill would be allocated as follows. So we have now the goodwill impairment loss based on 100% fair value or full goodwill. Okay, so we have now 3,750. 20% goes to the non-controlling interest. Now in E4, we debit to dividend income. Take note that in the books of the parent, there is dividend income of 28,800 understood to be dividends received from S Company. And the dividends paid by S Company is 36,000. 80% is credited by Pascal to dividend income of 28,800, and the 20% is to the non-controlling interest. So we now close by debiting dividend income in the books of Pascal 28,800, and debit non-controlling interest for 7,200, and credit to dividends paid. Now, to eliminate intercompany dividends and
Yan,
non-controlling
ikaw
interest
sanay.
share of dividends. Next, in E5, we have now the debit to non-controlling interest in net income of subsidiary and credit to non-controlling interest. To establish non-controlling interest in subsidiaries, adjusted net income for 20x4. If the net income of the subsidiary is equal to 60,000, and the amortization of allocated excess in E3 is 13,200. Now we multiply the difference by 20%. We have the non-controlling interest in the income of the subsidiary. Now we have 9,360. That's the non-controlling interest in net income of subsidiary. So finally, with all these figures in number 5, we have now the worksheet for consolidated number 6, worksheet for consolidated financial statements on December 31, 2024 using the partial goodwill approach, the 80% owned subsidiary. So we have now the sales of the parent and the subsidiary, total of 720,000. Then dividend income is a credit in the books of P. Now we have two debit in E4. We now refer to the numbering above. So E4, where we debited to ari nga aton nga E4 nga entry, debit to dividend income 28,800, debit to non-controlling interest 7,200, and credit dividends paid by S. So we now have number 4, E4. Then cost of goods sold of 204,000, cost of goods sold of Pascal, and 138,000 for subsidiary. And we have now E3 adjustment, debiting to inventory, and debit and credit to inventory, but that will correspondingly here. We have entry in number 3, to go back to the entry so we can see what entry was made. So the entry in E3, debit to cost of goods sold by 6,000, credit back inventory by 6,000. So that was the entry in E3 that's now reflected in our worksheet. So cost of goods sold is a total of 348,000. Depreciation expense initially for 60,000 and 24,000 initial amount of depreciation expense. So we now have the adjustments for number 3, we are adding 6,000. So that makes a total of our depreciation expense of only 24. So please make correction. Depreciation expense, P company 60,000, S company for 24.